The world's greatest geologist is on the verge of his next billion-dollar discovery. With looming shortages in copper, zinc, gold, and silver, this may be the best opportunity hard asset investors have ever faced. Learn more at futuremoneytrends.com/hardassets. Greetings and thank you for joining us at futuremoneytrends.com. I'm with a very distinguished guest, Mr. John Williams of ShadowStats.com. He's a great free market thinker and a private business solutions provider. The government has been fairly reckless and manipulative with their economic indicators and economic stats and studies, and Mr. William has done his best to provide honest information to companies and consultants and fund managers and newsletter writers like myself, so that people can get an honest picture of what the economy actually looks like. John Williams, thank you for joining us today.
Thank you so much for having me.
John, we have talked several times over the past 3 or 4 years, and I wanted to ask you, we've seen a significant amount of civil unrest in the past year with the Black Lives Matter movement. And I wanted to kind of just see what your take on it was, if this was more of a result of hard economic times, especially for impoverished to lower income individuals or lower income areas, or if this really was something about race, or if this really in reality is probably more tied to the economy.
Well, the economic times have not been good, and that usually has many people dissatisfied of anyone who's suffering it, which is the bulk of the population. I'm not an expert on race relations, and I just leave it at that.
No problem. Okay, so you have predicted hyperinflation and given a few dates, so that you've had to move those dates in previously, the end of 2014. And I just wanted to ask you, what happened? Why aren't we seeing the expected hyperinflation or currency crisis? Because it does feel like what we are experiencing is kind of like both. You've got really crazy inflation in housing and healthcare and college, but then you've got severe deflation in commodities.
Well, the circumstance here is one that addresses the general solvency of the long-term sovereign solvency of the United States. Back in 2004, when the gross federal debt was about $8 trillion, the government updated the Medicare system with the creation of roughly another $8 trillion of unfunded liabilities. They did this without funding the system. And at that point, it was obvious that the U.S. would never be able to meet its obligations. I started looking at a hyperinflation by the end of the current decade. When we had the crisis in 2008 and the way the government responded to that, that brought in the forecast horizon to 2014. The reason that it did not happen in 2014, certain things happened to generate a very strong rally in the U.S. dollar, which I'll discuss and why I think it's way out of whack. We still face a massive decline in the U.S. dollar, and I look for that to be the proximal trigger for much higher inflation that will evolve into hyperinflation, but it hasn't happened yet. Several factors behind that. Again, back in 2008, the Fed started quantitative easing, looking basically to debase the U.S. dollar. In 2011, you came close to having a continuation of the panic in 2008 when Standard & Poor's downgraded the U.S. Treasuries. You had a panic decline in the dollar, and then all sorts of interventions. The Swiss franc was pegged to the euro. A lot of jawboning, a lot of trying to redirect the markets to the liquidity problems in Europe as opposed to those in the United States. And they bought a little time politically. But all that's been going on here has been buying time. The crisis in 2008 was one where the financial system literally was on the brink of collapse. And the federal government, the Fed, did everything within their power, created whatever money, guaranteed whatever funds, spent whatever they had to keep the system from collapsing. They couldn't let the system collapse. But they did nothing to fundamentally alter the direction of all the factors that had led to the crisis. The economy was not addressed. Banks were addressed a little bit, but the solvency issues there are still not fully resolved. And certainly nothing's been done to fundamentally alter the long-term solvency issues of the United States. We have $100 trillion in total liabilities, unfunded, and debt that the government can never pay, and it means eventually the dollar is going to be debased. So coming into 2014, we had a circumstance where, with heavy selling in the U.S. dollar, what I was looking for to happen, I think, would have happened. But around mid-year, the Russians attacked Ukraine, and the U.S. Began to impose sanctions. Openly, we imposed sanctions against some of the officials, but covertly, there were actions taken to create financial stress for the Russians, such as knocking down oil prices and rapidly boosting the value of the dollar. All of that would hurt Russia financially, particularly the oil prices, but raising the dollar's value was a good way to bring down the relative oil prices. And the timing there is it was to the day when they were putting forth the open sanctions against the public officials. The rest of the world started to look for a reason to rally around the dollar, and the Fed began to talk about how strong the economy was, and they'd be able to raise interest rates. Well, they're still talking about that. The economy really never recovered; it hasn't strengthened, and the crazy thing with the Fed is that they never did the quantitative easing to boost the economy. The Fed's primary function, although they're supposed to help keep the economy on an even keel and keep inflation in check, their primary function is to keep the banking system afloat. They weren't doing that into 2008, and everything that they did after that primarily was aimed at providing the banking system with liquidity, with keeping the banks afloat. The quantitative easing largely benefited the banks. It didn't benefit the economy. The money didn't flow back into the economy. The banks didn't lend all that cash into the economy. They gave it back to the Fed and earned interest on it. So it was a bailout for the banks. But the Fed used the quantitative easing as they used the economy as political cover for the quantitative easing. They're still doing that. There's a very serious problem for them right now because the economy is not improving, and they may have put themselves in a position where they really can't raise rates the way they need to. Higher rates would actually be good for the economy. People living on fixed income could get some return on their cash. Banks could actually become more lenient with their lending because they'd have greater profit margins in the interest rates and could take on the lower quality debt. But the Fed has tied this all to the economy. The economy remains in serious trouble. And so as the economy becomes increasingly troubled, and I'll contend that it's in a downturn now, or a new downturn, never recovered, you'll see increasing selling pressure on the dollar. And where the dollar in many ways should have sold off in 2014, it didn't. I mean, circumstances evolved, and it's still the dollar right now is very strong. But I'm looking for a very sharp shift in domestic and global sentiment against the domestic economy. And as that comes into play, you'll see very sharp selling against the dollar. As the dollar sells off, oil prices are going to spike, domestic inflation will spike, and as the flow out of the dollar intensifies, you'll see ever greater inflation, and that will give you the underpinnings for the early stages of hyperinflation.
John, the world seems to be kind of in a mess right now, definitely heading into a second leg of the depression that started in the early 2000s, with the financial crisis being a major crisis, and it seems like we're kind of heading into that right now, literally as we speak on the phone right now. But it appears that the Dow is going down, the dollar is rallying with gold, and Treasury yields are about to fall below 2%. Probably end up, the 10-year may even go negative fairly soon here with expected reactions you can imagine from the central bankers. So my question to you is, with so much, and correct me if I'm wrong on any of this, of course, with so much going on and chaos in the world, isn't it going to be hard for the dollar to have any selling pressure because people are going to go to the dollar worldwide for safety from both the stock market and other currencies?
Well, what we're seeing in the United States is artificial, but what dollar strength you're seeing, there's been some supposed flight to quality, but you also get flight to quality in gold, and that's one reason central banks have been bashing gold. But the reasons for the flight to the dollar, other than all sorts of machinations around the Russian circumstance, have been purported booming economy and the Fed's indication that it's going to raise interest rates. Relative economic activity and relative interest rates are probably the two most important factors. In terms of relative political stability and such, I don't think you could say that we're in much better shape than the rest of the world, and certainly in terms of fiscal shape, we're not. Most people may not recognize that, but again, the rest of the world was looking to panic against the dollar back in 2011. The U.S. was able to buy time, but the U.S. has done nothing to fundamentally alter its basic circumstance, and the props of the higher interest rates. Whether or not the Fed actually raises rates doesn't make much difference. I think that's already discounted in the markets. But the economy is turning down sharply, and with that will go the expectations will shift that the Fed is actually going to have to ease again, and where the concept of the Fed tightening has been a big prop with the dollar, reversing that will give you heavy selling on the dollar, irrespective of any relative problems in other currencies. From a fiscal standpoint, we're worse than any other major country in the world, despite all the bad press that others have been getting. I mean, no one has destroyed their fiscal credibility more than the United States in terms of being a major economic power, major Western currency.
Do you think the Fed is going to raise rates next month, John?
No. I mean, they keep talking about it. I think we could have had this conversation last year. The problem is the economy is turning down. Let me explain why. The economy never recovered. If you look at the economy as touted by the federal government, it crashed into 2009, then it recovered. By 2011, the economic activity was purportedly was above where it was at its pre-recession high. Just continued to boom along. It's the GDP adjusted for inflation is 8% above where it was before the 2000 recession started. My contention is that the economy crashed and then it sort of bottom bounced. It's been stagnant at a relatively low level of activity. And you'll see that in a number of indicators, such as the housing statistics. Although you've had some recent strength, they're still 50 to 60% below their pre-recession peak. If you look at industrial production, right now it's contracted the first and second quarters. We're seeing annual contractions that you never see outside of a recession. The level of real retail sales growth year to year is at a level that you would see in recession. Real earnings are falling quarter to quarter, and therein you have a basic problem. That is, in order for the economy to grow, if someone says, "Oh, the economy is booming along. This is great." Why? How? What's driving it? The U.S. economy usually is driven by the consumer. But what you'll see is that the consumer still has not recovered from what happened before, but where he was before, or even at the end of the formal recession. Income levels fell, not only through the recession, but beyond. Again, we're below the levels in terms of household income, median household income adjusted for inflation. The only way that the economy can grow, or the consumption can grow faster than income, is if you have debt expansion, or people liquidate their savings. Savings have been strapped in the consumer credit has shown very little growth except for federally sponsored student loans. Bank lending to the consumer generally has been flat. You had a tank and it's been bottom bouncing. Again, that's adjusted for inflation. Point is that with that, and although consumer confidence has recovered to recent highs, that's turning down again, and historically that's at levels that have been seen at the depths of recessions. This is not a booming. These are not, although they're relatively high. These are not booming confidence numbers. The consumer doesn't have the wherewithal. He doesn't have the income growth. Doesn't have the ability to or willingness to take on the debt that might offset that. And as a result, there's no way you're going to see sustainable growth in consumption or the housing market, for that matter, which those factors which are very heavily driven by consumer liquidity. So until the basics are altered, until income rises or the banks become more lenient in their lending to consumers, you do not have an economic recovery in hand. Aside from a lot of numbers indicating that we're in recession, what you have to consider here is the GDP, which is in theory the broadest measure of economic activity in the United States. Or it's not in theory. That's what they claim. That actually is not the case. The broadest measure is the gross national product, GNP. The difference is that the GNP includes trade flows tied to interest and dividend payments in and out of the country. The way the government works with its reporting generally is that there are always some happy assumptions built into the numbers. Reason being, nobody wants to have the political embarrassment of having underestimated economic growth. Coming out of the 1983 recession, the government underestimated jobs growth. That's very embarrassing for the Bureau of Labor Statistics. And talking to people at the time, what they did to adjust for that was they put in an upside bias factor that added in 160,000 jobs a month or something like that, just for good measure to keep things on the plus side. And then in later years, they'd go back and benchmark and move the numbers to where they were in reality. You see this happening across most of the major series, and you usually get annual benchmark revisions. We just had one on the GDP, and what happened there is almost always happens is that where they have harder numbers and they go back, they have they'll take a census of different industries and retailers and such, and with those harder numbers, they go and they reestimate the GDP. It gets revised lower almost always. We saw that happen again. The growth is flattened out. They did the same thing with industrial production. As a result of this recent revision to industrial production, where the manufacturing sector had previously been reported having regained its pre-recession high, now it hasn't. It hasn't recovered. That's the manufacturing sector, big part of the U.S. economy. The problem with the GDP and its benchmark revisions is that the one last year didn't account for changes in 2011. And they moved on to 2012 as the earliest benchmark year this year. The reason the 2011 one didn't work was because of the government shutdown, and the reports just were not prepared on a timely basis. Had they put those numbers in place, you would have seen a downside revision in the GDP last year, at least a much bigger one than took place. And with the effect that in the periods where they've been putting in more realistic numbers, you now see a much flatter pattern of economic recovery in the GDP. And in fact, it looks like we had a recession now in the last half of 2012, where there was no economic growth in revision. The same thing probably happened in 2011. So that when all these numbers are finally adjusted, which may not be till 2018, and they go back and revise more than 2 or 3 years back, I think what you'll see is that we had an economic collapse that has had multiple subsequent dips in it, even in the official numbers. This is not a healthy economy. I think the average guy knows that. The numbers ahead are going to get a lot worse, and as they do, the Fed going to find it very difficult to raise rates despite its continuing waffling back and forth. Even if they raise the rates, because of what the implications will be for the financial system, for the Fed, for the budget deficit, the weaker economy is going to hit the dollar hard.
John, last question. We have about a minute left. On the Federal Reserve, do you think that they believe their own numbers, or do you think that they are aware that their numbers are flawed, but they are just using the flaw as propaganda? Or do you think you think Yellen's looking at these numbers from the BLS, and does she actually believe them?
Well, the numbers are consistent with her definitions. I think the numbers that they talk about are being used purely as a propaganda measure in terms of what they're doing. Oh, we have to get the unemployment rate to such and such, or see improvement here, and she has a pretty good sense of reality. One thing she looks at, for example, and it's a reasonable measure. There are a couple of measures that you can look at in the Bureau of Labor Statistic numbers to get around some of the biases that they have in the system. She likes to look at what they call the participation rate. That's the official labor force, the number of employed and unemployed. And to be unemployed there, you have to have been looking for work in the last 4 weeks. If you haven't done that, you're a discouraged worker, and they don't count you in the headline labor force. But if you take the participation rate, that labor force as a percent of the population, that's at an historic low. They say historic low. They may say, we used to get that low in 1984 or something like that. They changed the way they report the numbers in 1994. Nothing before 1994 is comparable with today's numbers. So that's at an all-time low. She has mentioned that very specifically in some of her press conferences, that she'd like to see that improve. I mean, it indicates there are real problems there in the labor market. Another one is the employment to population ratio. And employment is, and also, that's off its all-time low, but it is indicative of still a very weak economy. All the stories about economic growth, and they know this, are exaggerated. Again, the biases are built into the system. The payroll survey, which gets all the headline play when the numbers come out, counts the number of jobs. It doesn't count the number of people. So if you have a couple of part-time jobs because you can't get a full-time job, you get counted twice as being employed, or being in the employment. The employment counts the number of jobs. If you look at the number of people with full-time jobs, that is yet to recover its pre-recession high. The number of the employment count is well above its pre-recession high, but the people with full-time jobs is not. And again, it's an indication of how weak this so-called recovery has been and how distorted the economy has become. Not normal times. The Fed knows that. The problem is, I think they know that they really need to raise interest rates, but they've created this relationship between economic activity and the raising of the rates, and they're hoping they're going to get a little bit of return where they can spike the rates. They're not going to get good numbers. And without those good numbers, I don't think they've got the courage to do it. They've created a monster. It's beyond their control. Not a good circumstance.
Well, John, unfortunately, everything you're saying is the truth. And I think every day, just like you said, the average person out there, even if they don't pay attention to any of this stuff, everybody knows and feels like the recession never left. And the data you're mentioning and citing, obviously, you know exactly what you're talking about. And anyone who's listening to this show, if they would like to see some of your charts or data or private numbers that you or methodologies that you're using, they can go to ShadowStats.com. They can even get a subscription to ShadowStats.com, and they can see the real numbers for themselves. John, again, thank you so much for your time, and hope to talk to you in maybe next quarter.
Well, look forward to it too. And again, thank you so much for having me.
Thanks, John. You have a great day.